From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, looking ahead to the Fed's next meeting as the ECB attempts to stand its ground and China begins to head the other way. We begin with the big issue, divided views on the Fed's next moves.
People are being a little aggressive.
So the Fed is going to have to move.
They've got to hike interest rates.
They've got to immediately stop QE.
Deliver the balance sheet reduction.
Could we actually see something a little bit more aggressive?
In March, it's go time.
For rate hikes.
There's been some rumblings, even a 50 basis point move coming out of the gate.
A 50 basis point hike in March.
The market is way too aggressive.
That just doesn't seem like the type of action that this Fed would take.
4 rate hikes on the table.
It's going to be more like 2 to 3.
If they're going to make a policy mistake, it's because they move too slowly.
We have 7% inflation. What could possibly be a bigger policy error?
It's frankly too late for the Fed to engineer a soft landing.
Joining us now to discuss is JPMorgan's Kelsey Berro, Goldman's Lotfi Karoui, and BlackRock's Bob Miller. Kelsey, I want to begin with you. The expectations, the range for this year is so wide. What's your base case now?
Sure. So we do expect the Fed is on track to start raising rates in March. We also think that they are going to use the balance sheet in a way that was different than in prior cycles. So we think that they feel that the balance sheet is this escape door for them, because if they hike too fast and they invert the yield curve, they risk short-circuiting the cycle. So instead, what they're doing is they're looking at running down the balance sheet at a fairly fast pace. We think about $50 billion per month in Treasury, $30 billion per month in agency MBS starting in June or July. And then they use that to tighten financial conditions, get real yields higher, and hopefully do it in a way that doesn't materially disrupt the recovery that has been well entrenched over the last 2 years.
Kelsey, that's the hope. You make it sound very simple, very easy. We all know it's not going to be. Bob Miller, your base case on the balance sheet specifically, because that's the interesting component in all of this. How on earth do you discount something that we haven't done in this size before?
Great question, Jonathan. I think it's precisely the right question in terms of what could go right and what could go wrong. The market's reasonably priced for rate hikes. The balance sheet is the question. So our view is this. It's that they can proceed with balance sheet runoff. Think about since the balance sheet tool has been introduced during the financial crisis a little over a decade ago. It's basically been used to deliver monetary policy objectives 6 times. Right? And the 3 times where the balance sheet was used with specified parameters, with explicit monthly targets and the number of months and the total amount that would be done, all 3 of those episodes, QE1, QE2, and Operation Twist, ended without elevated volatility in financial markets. The other 3 uses of the tool, the quantitative tightening, QE3, which ended with a taper tantrum, was open-ended. The quantitative tightening example in 17 and 18 was open-ended, ended badly. And this time, the quantitative easing post-COVID, open-ended, $120 billion a month until substantial further progress, whatever that ever meant, open-ended, didn't end well, right? So our recommendation is simply this: do balance sheet runoff in specified increments. I wouldn't disagree with Kelsey. Whether it's $75 billion for a month for 18 months or $100 billion a month for 12 months, get somewhere in that $1 to $1.5 trillion total number, which will effectively drain the RRP, which is currently sitting a bit north of that. Just drain that, stop for a minute, observe what's going on, and see if you need to do more. But don't do the open-ended QE or QT exercise. I don't think it will end well.
Lotfi, if they do everything that Bob just described, and perhaps the numbers that Kelsey laid out for us, do you think that replaces or complements rate hikes?
It's a great question. Our view is actually pretty similar. We think they'll probably go in July in the tune of $100 billion a month. And so to put that number in context, in the last cycle, the Fed started at $10 billion a month and then ramped it up to 50. And so the number is substantially bigger this time around. Some of that reflects the size of the balance sheet, which is itself bigger. But I think, on the positive side, relative to the last cycle, the plumbing of the market seems to be in a better shape today, particularly the fact that the Fed has the reverse repo facilities and the repo facilities that should allow for the withdrawal of liquidity to happen at a gradual pace. To me, when you go back to that 2018 episode, there's certainly a lot of lessons to be learned there. But one of them is that maybe the plumbing of the market was not in a shape that was good enough to withstand a pace of balance sheet runoff. This time around, I think we're in better shape. Now, for risk assets, I think you always have to think about the drivers of the backup in rates. The rule of thumb that is generally used is that, a balance sheet reduction that is equivalent to 1% of nominal GDP would translate into 2 basis points of backup in longer term yields. Of course, there's significant uncertainty around that number. But more importantly, I think what matters is the composition of the move. What we've seen the last 2 weeks is a sell-off in rates that is entirely driven by real yields. If that repeats itself over time, you could create a little bit of an indigestion for risk assets, as we've seen the last 2 to 3 weeks.
A question I'd ask all three of you related to that is how far they can take the Fed funds rate as well. Kelsey, I caught up with your good friend and colleague, Bob Michael, a little bit earlier on this week. Take a listen to what Bob had to say on how far the Fed could push interest rates.
It's frankly too late for the Fed to engineer a soft landing. They now have to focus on getting inflation back down. We're going to see a Fed funds rate that's going to get to 3% minimum in this cycle. And by the way, it's not so preposterous to get to that level. We got to 2.25%, 2.5% back in 2018.
Bob Miller, can we get to 3 without something breaking?
Tell me what's going on with the balance sheet, right? I think you have to view the combination of those tools. So if there's no balance sheet runoff, then 3%, seems a bit high, but it's probably in the distribution of outcomes. If the balance sheet is running down at $100 billion a month, then I think 3 is a lot. I mean, it is interesting that 4 to 6 months ago, a majority of the marketplace was dismissive about inflation pressures and thought the Fed was going to be on hold for a very, very long time. And now sentiment has swung wildly in the other direction. They're going to move. I think they are going to hike 4 times this year, and I think they'll probably get the funds rate up to 150, maybe 2%. But if the balance sheet's running off in the background for a while, I don't think they're going to need to hammer the economy. I disagree with that point of view. Inflation is not, you're going to have the same degree of price increases in order to keep inflation up here. It's entirely plausible we're going to have reset the price level in the economy, and inflation, the rate of inflation decelerates fairly aggressively over the next 2 years.
Well, that could start in spring. The base effects start to kick in the opposite way to how they kicked in 12 months ago. So, Kelsey, Berro, give me your view on that. Can we really get to 3 with the balance sheet reduction that you describe and a Fed funds rate at 3%?
Well, I think Bob does bring up a good point there in terms of the interaction between balance sheet and the Fed funds rate is very untested. So we do need to see what's going to be going on with the balance sheet. We also need to see what's going on with inflation. I think there is a fair argument that you're going to see some deceleration in inflation over the next few months. But what I really have my eye on is wages, because that's what we're watching. We're watching, are we at risk of a price wage spiral? I think at this point, we don't know for certain, but we have the ECI number next week. And I really want to key in on that, because if you listen to what Chair Powell said at one of his recent congressional testimonies, he revealed that the Q3 ECI number, the Employment Cost Index, was really a turning point for him. It's what made him reassess the amount of tightness in the labor market and where the underlying pressures of inflation were going. So if we get another 1% quarter on quarter in ECI, that's going to be 2 in a row. We haven't seen that since 2004. So that's what I would be watching to see if the Fed can continue to raise rates beyond the first 4 or 5, which we expect 4 this year.
He was very keen to point out that was the key data point and not the fact he got a second term at the Fed. We can come back to that another day, Kelsey, perhaps. Standard Chartered have got a view. This is Steve Englander. We doubt Fed Chair Powell will endorse the 4 hikes that are now priced for 22. We see an inflation peak in late Q1 as reducing the urgency of rate hikes. But until we see that peak, the doves are on the back foot. The doves are on the back foot. And Lotfi, before we go from this segment, I just want to finish up with this. I spoke to someone this morning just about the sequence and the timeline compared to the previous decade, the previous cycle. And just the runway last time around, in 2013, they started talking about tapering. In 15, 2 years later, that's when the rate hike conversation came. 2 years after that, that's when we started doing balance sheet reductions, so-called QT. Lotfi, your thoughts on the fact we're doing all of this in just a couple of months, maybe 6, compared to what we did last time around across several years. How important is that?
I think you're absolutely right. I think last cycle was all about optimal control and doing things in multiple sequences. This time around, it's all happening at once. But I agree. I found it quite remarkable that the Fed is still buying a significant amount of bonds while at the same time talking about hikes and quantitative tightening, et cetera. I think that just speaks to a key differentiator of this cycle relative to the previous one, which is the velocity of the recovery, the velocity of the moves in financial markets themselves has been nothing shy of spectacular. Is there a risk that things go too fast? Absolutely. I think there is a risk. But again, I would agree with what Bob mentioned earlier, which is there's 2 key elements here. Things are data dependent, number one, and a lot of it will depend on when inflation goes. Now, our view is that will probably peak in the first quarter of the year, and then after that will decelerate slowly, but we will be on a decelerating path. The question is, what's the equilibrium level eventually, or where we settle? We think, 2.2%, if you take the Fed's favorite inflation measure, which is core PCE, is likely, but arguably there's a lot of uncertainty with that, and I certainly don't disagree with the concern that things might be moving a bit too fast here.
Lotfi Karoui, alongside Bob Miller and Kelsey Berro. Sticking with us, coming up on the programme, the auction block, Wall Street's biggest banks dominating issuance in the primary market. That conversation up next from New York. This is Bloomberg. Live from New York City for our audience worldwide, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with another steady week of issuance. Monthly sales approaching 200 billion euros, the busiest start to a year on record. America's biggest banks driving supply in high-grade bond markets this week, pushing monthly sales close to estimates, with more than a week remaining in January. And the junk bond market heating up following a slow start to the week, pricing 4 billion on Thursday alone, the busiest session in 3 months. Back with us, Kelsey Berro, Lotfi Karoui, and Bob Miller. Kelsey Berro, I want to start here in the credit market, and you make a really, really good point. The corporate fundamentals are something you have confidence in. You're trying to balance that, though, with the tighter financial conditions you expect. So, Kelsey, what do you do in this environment?
Yeah, absolutely. That is what we are trying to do. We're trying to balance the fact that despite the fact that we know that central banks are removing accommodation, we don't want to throw all the work that our credit analysts have done totally out the window. We know that corporate fundamentals are strong. We know that consumer balance sheets are strong. So where we're focused is getting credit exposure, but in ways that are structured to be protected against higher rates. So for instance, bank loans is a perfect example. They have a floating rate component. If you look at how they performed year to date, despite the fact that high yield is down about 1.5%, loans are up about 50 basis points. Another area we're focused on is short securitized credit. That's a way that you can play for the strong consumer balance sheet. Those are things like auto ABS, consumer loan ABS, because we know that the consumer is still flush with cash, about $2.5 trillion in excess savings, and that's not going to go away immediately. That's going to go away over time.
Kelsey, how would you balance that with your exposure to, say, inflation protection? The story of last year, a lot of people rushed towards getting inflation protection. It seems to me coming into this year, it's all about floating rate, get an exposure to higher interest rates and protection from that as well. If you're going to bet on the success of the Fed, do you do everything you've just said and move away from inflation protection?
Yeah, this may not be the year for tips. I mean, last year was absolutely a great year for tips. They had massive inflows. So if you look at the 2 years of the pandemic period, you had 5 times more inflows into tips than you had in the 2 years prior to the pandemic. And that's what drove financial conditions to be so easy. And I think one thing we haven't spoken about, the show is the Real Yield Show. We talk a lot about the levels of real yields. It's not only about the level of real yields, it's also about the slope of the real yield curve. And that slope is still very, very steep, meaning that front-end real yields are much more negative than longer-end real yields. So when financial conditions tighten as a result of the Fed removing accommodation, what you should see is that real yield curves start to flatten. You're going to see negative total returns for tips, and that's not a place that I'd be positioning right now with the Fed on the move.
Lotfi, let's talk about the credit side from your perspective and why you think we'll continue to see resiliency in credit versus, say, equities. Lotfi, why is that?
I think credit has been a tale of two views. I would agree with Kelsey that fundamentally it's hard to make a bearish case against the asset class, but you have liquidity positions that are at their best level in probably 2 decades. Even growth, even if it slows down, the fact of the matter is you still have an economy that is growing above trend through most of 2022. And so fundamentally, I think the market is well supported. On the other hand, from a performance or evaluation standpoint, I think we have to be very clear about that. There is very little upside in owning credit at these levels, at least on the public side. The best you can hope for is really that nothing changes for spreads, and then you got to continue to clip your coupon here. And so from a performance standpoint, I would describe 2022 as the year in which we're going to transition in the fixed income markets towards a period of much lower returns relative to anything we've seen the last decade, certainly relative to the aftermath of the global financial crisis. Now, practically, where do we go in credit? We do think that the direction of travel is modestly wider here, call it 10, 15 basis points if you take the Bloomberg IG index as an example. That just realigns spreads with the reality of a cycle that is actually aging and maturing at a rapid pace. But if you benchmark that level relative to, say, the history of the last 2 decades, it's still reasonably tight. But I think that the trough for this cycle in spreads is definitely behind us.
This sounds very realistic. It doesn't sound terrible. Bob Miller, when I read some research from Bank of America this morning, which basically said the Federal Reserve is hiking interest rates into overvalued equities, overvalued credit, this feels very 2007. When you hear things like that, Bob Miller, what's your response to it?
They need to recalibrate policy in an effort to extend the cycle, right? So can they engineer a soft landing? I think that is the critical question, and I think it's possible. It's not necessarily the most likely outcome, but it's possible. And it goes back, I keep going back, I apologize for going back to the same point all the time, but I really think it comes down to how aggressive are they with both of their tools, and do they overreact or overdo it this time around, similar to late 18, or is it a more deliberate path to recalibrate policy, appreciating that there are a number of highly unusual factors at work at the moment related to economic shutdown and reopening, related to a pandemic. It's just different this time. So I don't think the old rules apply. I do think there's a path to land the plane. I'm concerned that policymakers globally have a tendency to overdo it in both directions. We're betting at the moment that the soft landing is a reasonable expectation, but we've got some hedges in place in case the policymakers decide to go a bit more aggressively.
And Bob, we're assuming they can fly this plane, that they can land it, because when you're reducing the balance sheet to this extent, and they don't have any experience with it, you're telling me that it's really, really critical. At the same time, we don't have much experience with this. Seems that they don't have much experience with this. Kelsey Berro's laid out some very, very big numbers that we could see play out in the next 18 months. Most of you have agreed. Bob Miller, you ended it by saying we're taking out some protection. So, Bob, can you tell me where the protection is? Because at the moment, the risk seems to be in the perceived risk-free asset. So, Bob, where do you get that protection?
Well, it's interesting. It's something you asked Kelsey earlier. We're short real rates. We have been for a while. They've started to move in the past couple of weeks. And I think you can win. So we're short tips. So I think you can win a couple of different ways there. Either I can see reals continuing to move back towards zero through modestly narrower break-evens out the curve especially, or modestly higher nominal rates. Any combination of those two things will continue to push reals higher in yield. And our expectation is very simply that with a Fed that is going to be raising rates and has signaled they intend to allow balance sheet runoff, potentially at a fairly aggressive clip.
Yeah.
That the combination of those two things definitionally will lead to higher reals. It's just a question of through which channel it moves the most.
Bob Miller sticking with us with Kelsey, Berro and Lotfi Karoui. From New York City, up next, the final spread, the week ahead, featuring that big Fed decision. This is Bloomberg. Live from New York City for our audience worldwide, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, ton of economic data on tap with US and Eurozone PMIs coming out on Monday, followed by consumer confidence and US GDP figures. And the main event coming on Wednesday, a Fed rate decision and Chairman Powell news conference. In the 90 seconds we have left, let's get to the rapid fire round with Kelsey, Berro, Lotfi Karoui and Bob Miller. Let's start with this one. I'm going to throw a question at you. You just have to give me a number. How many hikes this year? Kelsey?
4.
Lotfi?
4 quarterly hikes.
Bob?
4.
Does balance sheet reduction get announced in March or later in the summer? March or in the summer? Lotfi?
July.
Kelsey?
Later in the summer.
Bob?
May.
OK. Final question to all three of you. I mentioned it at the top of the programme. The ECB is trying to sit this one out. They managed to do that last time around. We had a full Fed hiking cycle. They had to back away eventually, but the ECB did nothing. Do you think the ECB can sit out this Fed rate hiking cycle this time around? Yes or no, Bob?
I don't know.
Lotfi?
It is the perfect question.
Yes, I do.
Kelsey?
No, they can't sit out this cycle, and we think that they may even raise rates as soon as December.
Wow. Interesting call. Kelsey, Berro, thank you. Lotfi Karoui and Bob Miller, thank you to you both as well, gents. From New York City, this was Bloomberg Real Yield. This is Bloomberg TV.